who are the product companies that we should seek out to make sure their products are in our sustainable buildings. So a sustainability rating of looking forward has many uses. It's a communication to your customers. It's a motivation for your staff. It's a telegraph to investors that you are respectful of them, you want to share information, and that you can let them look inside your business to know risk and return. All right, so here's examples of two investors who are looking to be sustainable, and you might notice something. They're women. As we talked about before, the people who are interested in sustainability, actually women is a core segment. Thinking long-term, thinking multi-generation. But there's other people who affiliate with sustainability. Engineers. Engineers think of the whole problem. They think of an interconnection. They think of something that's going to work over and over again, just like chemical engineers. Entrepreneurs. Entrepreneurs aren't satisfied with how the system is today. They're always trying to improve it. So she actually is a women engineer. Her job is in sustainability. This is her financial advisor who's just getting to learn about sustainability. And they wanted to know, they had picked these funds, but they had sort of picked them by name. They hadn't looked inside deeply. So they wanted to know how those funds rated. So with 7,000 ratings, we're able to give each fund a rating, not only each company, but each fund. And at least for this time period, these were very good performers. But we said, okay, if these are renewable energy focused or energy efficiency focused, how do they compare to general energy? And this is the human capital fund. There actually is one that's an active approach. So for this time period, here's the energy index. It's big because that's where all the money is. It's black because it's got oil and gas and carbon and coal in it. And then here's a BlackRock iShares Global Energy, and here's the coal index. So as you can see, these funds pursuing a renewable energy in a natural resource efficiency strategy are lower risk. They're to the left. They're also, in some cases, higher return. Or, if not higher return for the risk. So the slope of this line actually gives it a higher Sharpe ratio, as they say. So this is what investors want to know. What is in my portfolio? Will I be surprised? Or even better, can I be inspired? Can I brag about what I own? So just for context, why is energy lagging? So for the most part, global energy, oil, gas, and coal, has mimicked the S&P 500 until about the beginning of 2012. And now they've diverged. Fossil-based energy is dragging down your portfolio. But when you look at the Fortune Global 500, there's a lot of market cap in fossil energy. And today, geopolitically now, what's happening in Russia, there's sanctions being applied to not buy natural gas and oil from Russia because of what's happening in the Ukraine. And if you think about this strategically, like an engineer or as a leader, why wouldn't we go renewable so we can be self-sufficient? So I think this theme of self-sufficiency obviously resonates in Thailand. We're always talking about self-sufficiency, talk about co-ops. And so it can apply to your portfolio. How do you build a portfolio of self-sufficiency? So here's the coal index, down, down, down 40%. Coal is high carbon. But carbon efficient firms, this is an index, not a fund. Index means it tracks the performance. A fund means you can invest in it. But since its inception, the true cost carbon efficient index has beaten the S&P 500. Companies that use energy efficiently, natural resource efficiency, with lower carbon, are performing better. That's because if you're more efficient, you're using less of it. And if a price spikes, you're less exposed to it. So here's another sustainable investor. She's part of the Global Conservation Network. Her job is working with zoos and aquariums. Zoos and aquariums care about conservation, and their portfolio was not positioned for conservation. Their portfolio was a traditional portfolio. The fund companies, when they called them up and said, I would like a environmental conservation portfolio, they could not help them. So we helped them build a portfolio, and this actually helped us discover something that we were working on, but really focused it about modern portfolio theory. So what we first did was take the carbon exposure of all the companies in their funds. They had a very simple portfolio. Cash had no exposure to fossil firms. One of their funds had 150 of the largest 200 fossil-based companies, oil, gas, and coal. And one of them had 7% of the fund value. This is actually a pretty large number. Usually energy is about 4 to 5%. This was double. And when you look at the companies in there, Consol Energy is a coal company. British Petroleum, we all know. Gazprom, this is the hidden stinker in most portfolios, diversified portfolios. Total, Hess, Occidental, and others you might recognize. So these are companies that are at risk of this problem. Remember we talked about invisible assets? These companies might have invisible liabilities. Those invisible liabilities are going to attack their assets. What are the assets of these companies? When you look at the balance sheet of these companies, what is one of their core assets? Reserves. So when they find more reserves, when we find more oil, gas, and coal, their balance sheet goes up. That should be great, right? More assets. But what if you can't burn the oil, gas, or coal? Will fossil fuel assets become stranded or actually liabilities? Because in a world of climate change, that more than 90%, 95% of all scientists say is happening, whoever's causing it, it is not sustainable to be reliant on fossil fuel. So the challenge for a portfolio is, and we just showed you that it can be stronger, is which funds have a high exposure to fossil fuel and which funds have a low exposure. Or which funds have no exposure. These are all investment funds across a diversified portfolio that have no exposure to coal, oil, and gas producers. And there's even another page of them. Now this is the list. This is the list of the fossil-free funds, but there's a 2-page list. And what it allows now the Global Conservation Network to do, to implement the portfolio that we designed for them, but also they are now, at our encouragement, writing these funds to say, are you sure there's no other company you want to hold in your portfolio that gives you a better risk return? Investors engaging with the fund managers to help inform and educate the fund manager. And remember, financial services are sold, not bought. So if the customer says they want something, the smart financial services people listen. Because the great thing about financial services, innovation is easy. It is easy. Selling is hard. Innovation is easy. Okay, so we talked a lot about companies. You can also have cities. So the city of Bangkok, or Chiang Mai, or Chiang Rai, or Hat Yai could have a HIP score around solving human needs. What is the health of the people in the city of Bangkok? What is the wealth of the people of the city of Bangkok? If we competed against other large metro areas like Shanghai and New York and Dubai, would Bangkok be at the top of the list or the bottom of the list? So this is one of the things that we do at HIP, is not only rate companies, we rate cities, counties, hospitals, universities. So for most universities, they get money from tuition, they get money from donors. But they also issue bonds to pay for building more physical capital. But what if a university issued bonds for human capital and scholarships and intellectual property? So that's a possibility for the future. It doesn't exist yet. So at least in the US, in comparing cities against each other, there's varying HIP ratings. You might hear about the city of Detroit. This is where the auto industry was based. And Detroit has a low score overall, 38, but actually has a very high score on equality. Now, what is happening in Detroit, a city that has lost about half of its population? People are not paying their water bills or stealing water. What is happening here for equality? One of the metrics is, what are the entrepreneurs in the city? So Detroit actually has a fair number of entrepreneurs because there's no jobs from large companies. And what is the proportion of women entrepreneurs? And in this case, 49% of entrepreneurs in Detroit are women. Nobody knows that story, even in the US. So this gives the opportunity for an investor to say, I want to support women entrepreneurs. How do we create a financial fund to help them succeed? And I can either do that by funding the whole city or by, again, innovating a narrow, focused product. All right, so what we've showed you and what everybody agrees is we hear the markets are efficient. We hear that all information is built in the prices immediately, and you cannot outperform the market. And for anybody who seeks to prove this, you can win. You can be rich. But we're still monkeys, talking monkeys. But the markets are frequently inefficient, and they don't build in this information. And portfolios can outperform the market indexes. And you can do this across your whole portfolio. You can do this where you save at your bank, whether it's SCB or Capricorn. You can do this in fixed income, in equities, both domestic Thai equities and international equities, in real estate, in venture capital. You can even do this in your charity. So for charity that is not religious, but for social enterprise, you could say, what is the impact of that social enterprise? And how is it part of my overall portfolio? So if you take the road trip, there's a route with a song in the US, Route 66. I won't sing it. And this is the cool car of 1952. It's a Cadillac, convertible. You can drive down, top down, music blaring. And I picked 1952 because modern portfolio theory was invented in 1952. Modern portfolio theory is a Nobel Prize winning theory. It says that if you're diversified, you'll get a high return, you'll reduce risk. And efficient markets usually goes along with that saying, you can't outperform the market. And we've just showed you several different metrics of how you can possibly outperform the market. And in 1952, you might have driven with a map. And this is the methodology for most financial portfolios. We're using paper maps. Now today, if we drive around Bangkok or Thailand, we're not using paper maps, we're using this. So why isn't your portfolio benefiting from the latest thinking? Because today's financial markets tend to be using the paper map, not the Google map. So across these different categories, it's still a low number of managers. So this is an investment consultant, Mercer, has looked at 5,000 funds. And in private equity, 1 out of 4 of those fund managers are integrating sustainability in some way. And in public equity, it's still only 1 out of 10. 9 out of 10 public equity fund managers doing nothing about sustainability. Not asking questions, not looking at data. That's kind of outrageous. Hedge funds, even less. These are the ones that you'd expect to be way out there, because hedge funds only believe in what makes money. And we just talked about all the arbitrage. Hedge funds are agnostic about what you invest in. So this is abnormally low. And this fixed income is abnormally low too. Investing in government, fixed income, or nonprofit institutions, that's an easy thing. So that's why we have these ratings on governments and nonprofits that get built into portfolios. So this is a traditional modern portfolio theory portfolio, risk, return, and colored by impact. This is a HIP 10 fund portfolio, diversified, focused on solving human needs. And this is a HIP 24 fund portfolio, more diversified. So you might say, so what? Like, what's happening here? The so what is very important. Modern portfolio theory as a portfolio is sitting here, and what's lower risk, and at least for 2013, we're going to show you 1 year, 3 year, and 5 year, a sustainable oriented portfolio versus traditional modern portfolio theory is lower risk and higher return. And that's on a 1 year basis, a 3 year basis, and what happens at 5 years is it's lower risk, as we talked about, and even though this is lower return, you're reducing risk more than you're reducing return. So it actually has a higher, what they call Sharpe ratio. Didn't put that one in. But what's really important to sustainable investors is the amount of carbon and the risk associated with carbon of these two HIP portfolios is 70 to 85% less. Your portfolio is not responsible for increased pollution from carbon, from driving a car or a scooter or running coal power plants. So that's what sustainable, well, the pictures of the people I showed you are people who are investing in this way. So this is the guy who invented modern portfolio theory, Harry Markowitz. He's actually on the verge of retirement. I've been trying to talk to him for a year. He won't return my phone call or my email. I think he's done. So he might be retired, but his modern portfolio theory from the University of Chicago won a Nobel Prize in 1990. But we need to ask the question, is it time to retire modern portfolio theory? Dun, dun, dun. So millennials who are coming into the workforce, working their way up to middle management, soon will be leaders. They'll also be inheriting wealth from baby boomers. They see the purpose of business as societal development and innovation and changing the world for the better as well as profit. This is a contrast with today's understanding of profit first at the expense of almost everything. Profit is a backward-looking measure. It's what's already happened. Building a better world is a future-looking measure. Now you need to integrate profit into that, but if profit is the goal, naturally it just becomes short-term profit. So HIP is a way to blend short-term and long-term. And when you do this, this is work we've done with companies, millennials, and their retirement plan. Millennials say, I don't want to invest unless it's sustainable. So before we worked with that company, only 1 out of 7 equivalent employees were investing. After they saw what the sustainability choices were, which is this graph right here, these are all their choices in their retirement plan. So we did a HIP score for each of the funds based on the actual holdings of the fund. 93% are now investing. So this can help bring more demand in business. This can help connect with people who want to do the world. And when capital flows, and it flows to companies that are sustainable and away from companies that are not sustainable, that changes the stock price. And the ones who are not doing that now say, oh, I need to do this. And it creates constructive competition. All right, so in summary, we're going to start to summarize here. How can corporations be more hip? So they can create and sell sustainable products and services, and this grows top-line revenue. You can measure the invisible operations so that you can discover new product potential. And you can integrate decision-making into the whole structure so that you reduce future risk. Every company and organization can do these three things: what you sell, how you operate, and how you make decisions. And if you want to know even more details, those are in the HIP book, chapters 4, 5, and 6. When you can be sustainable for both, you have a high likelihood of being a 100-year brand. If you're down here, you can't sustain yourself financially. And these are unsustainable business models over the long term. You might make money now being unsustainable. You won't make money forever. What if you're an investor or a fund? One of the things you can do is vote with your dollars and overweight sustainable investments and underweight unsustainable ones. No company is perfect, but reward the leaders and penalize the losers. And it's your money, so you should do that. You can evaluate funds as to their components of sustainable companies and help educate the fund manager by asking questions, or your advisor. And finally, you can diversify your portfolios based on risk, return, and impact. And hopefully I've shown you a tremendous amount of information that shows that impact plus profit is synergistic. All right, so I wanted to give you some spicy things for Q&A, which will start in a few minutes. These are selected Thai companies from the HIP database. You might know them or even work for them. This top level, materials, industrials, oil and gas, and we'll cover some other sectors. These are top level sectors, 10 sectors, and then these are down at the industry level, commodity chemicals. So you have Indorama and IRPC. Their HIP score for available information is 45%. What we've done is compare them to everybody else in commodity chemicals. And so they're a top quintile company. SCG has a HIP score of about 45. For their sector and industry, they're in the top quartile by sector and the top third by industry. This is global industry. And then PTT, CAM, E&P, and PTT have varying HIP scores based on the components of their business. Relative to others in their industry, they're actually well ranked, another support for the Dow Jones Sustainability Index. So this isn't saying they're purely sustainable, because obviously being in a carbon-based business, they're going to have to shift their business. But this is how they're performing relative to other choices in the sector. If you picked the more sustainable in this particular sector, the range of PTT companies is doing a good job, top decile. All right, so here's mobile telecom, advanced information services, top half sector. In coal, Banpu, relative to other coal companies, is actually almost top decile. Now again, coal is a high-risk business today. Farm fish plantation, this is just about median, depending on how you're looking at it. Tyrone. We have Thai Airways, so that's on a high global, on a sector basis of consumer services above the line, but for airlines, not as strong. These are bank scores for SCB, Capricorn, and Tisco. So they're above the median. This version of PTT Chem got delisted. And then I think we're coming to the last one. Second to last one. We have broadcast, BEC World. Lower HIP score, 21, bottom quintile. So the good news is they're reporting, they're transparent, you can see what they're doing, but on a relative basis for a globally diversified portfolio, they may not be as strong. We have CP, sometimes loved, sometimes not. And then Glow Energy. And then this is the last page. We have retailers, yeah, macro. So this is bottom quintile. And then Home Product Center. And then finally 3 more banks. Bangkok Bank, Bank of Asia, Krung Thai Bank. So for these companies, the average HIP score, looking at all of them, is about 30. And it puts them at about the median. So the companies that are listed here are the median relative to the sector and to the industry on a global basis. We can also cut this by region, segment this by region, and segment it by market cap. But if what this means is you want to build a portfolio that is weighted higher towards impact, you can decide, I want to do that in Thailand, I want to do that in ASEAN, I want to do that globally. And these scores can help you do that.